companies establish a chart of accounts, which is a list of all account titles and their unique numbers. The number and type of accounts used differ for each company depending on the size, complexity, and type of business. In this video, we will focus on the account titles that are commonly used. The accounts are usually organized by financial statement element, with asset accounts listed first, followed by liabilities, then stockholders' equity, revenue, and expense accounts. We will discuss most of the accounts in each element. The balance sheet reports assets, liabilities, and stockholders' equity, whereas the income statement reports revenues and expenses. Assets are the resources owned by a company that provide future benefits. Current assets are those assets that a company expects to convert to cash or use up within the year. The account titles are intended to be descriptive of what they are representing. For example, cash represents the amount of cash the business has available. If a company has excess cash, it might invest in a short-term investment, such as a T-bill. Accounts with the word receivable in the title are assets. Accounts receivable represents amounts owed from customers. If a business sells goods to a customer and does not receive cash immediately, then the company has a right to expect payment from the customer in the near future. This right to receive money in the future is called an account receivable. Allowance for doubtful accounts is a contra asset account containing the estimated uncollectible accounts. We will discuss this account in detail in a subsequent video. Interest receivable represents interest that has been earned but not yet received. Goods available for future sales to customers are called inventory, whereas supplies are items used in the day-to-day operations, such as office and cleaning supplies. Prepaid expenses represent amounts paid in advance by the company for future benefit, such as insurance and rent. Non-current or long-term assets are those that will last longer than 1 year. For example, investments in stocks and bonds of other companies that are expected to be held for more than 1 year are classified as long-term investments. Land, buildings, and equipment are assets with relatively long, useful lives that are currently used in operating the business. The accumulated depreciation account shows the total amount of depreciation that the company has expensed since acquiring the asset. We'll talk more about this concept in subsequent videos. Intangible assets have no material or physical substance. One common intangible is goodwill. Others include patents and copyrights. Current liabilities are short-term obligations that the company is to pay within 1 year. Accounts with the word payable in the title are liabilities. They represent amounts owed by the company to be paid in the future. Notes payable is typically used when a company borrows money from a bank, whereas accounts payable represents monies owed to suppliers. For example, a company may purchase goods on credit from suppliers. The obligation to pay for these goods are called accounts payable. Accounts with the word unearned in the title are also liabilities. They represent amounts paid to the company by others who expect future goods or services. We'll talk more about this concept, but for now, just make a note that unearned service revenue is a liability. Liabilities result from companies incurring expenses. It may have wages payable to its employees, interest payable on the amounts owed to the bank, and income tax payable to the government. Non-current or long-term liabilities are obligations that a company expects to pay after 1 year. Examples are long-term notes payable, as well as bonds and mortgage payable. Stockholders' equity represents the financing provided by the owners, as well as reinvested earnings. Stockholders' equity consists of two parts: paid in or contributed capital, which represents the financing from the owners, and retained earnings, which is the amount of earnings reinvested in the business. Net income increases retained earnings, whereas dividends reduce it. There will be numerous videos that explain stockholders' equity transactions and the accounts we use. For now, we will simply use common stock and retained earnings. Sales revenue results from the sale of goods, whereas we typically use service revenue for the performance of services. We will discuss these other revenue accounts in subsequent videos. Accounts with expense in the title are expenses. They represent amounts of resources the company used to earn revenue during the period. Of course, there's always exceptions, such as cost of goods sold, and this represents the cost of inventory that was sold during the period. Don't forget about prepaid expenses, and hopefully you remember that this account is an asset.